This video provides a strategic analysis of the impact of aircraft leasing on airline profitability, focusing specifically on new airlines. The capital barrier is hostile to new airline entrants, with aviation being highly capital-intensive. Traditional ownership models demand immense upfront capital. This includes visible costs, debt pressure, depreciation, and high fixed costs amidst unclear market demand. Aircraft leasing acts as a financial equalizer by decoupling ownership from operational control. It allows airlines to operate planes without the full financial responsibility of ownership. As of 2023, 58% of the global commercial fleet is managed through leasing, making it the dominant financing channel. We can demystify core leasing models. The operating lease offers high flexibility and low risk. The finance lease treats the aircraft as an asset with long-term control and higher risk, and the dry lease, which covers only the aircraft asset. Tactical leases include the wet lease, providing the full package for short-term capacity, the damp lease, a hybrid model including the flight crew, and sale and leaseback, which unlocks immediate liquidity by selling and then leasing back an owned aircraft. Leasing transforms the cost structure by shifting aircraft acquisition from massive capital expenditure, or CapEx, to predictable operating expenditure, or OpEx. This preserves vital cash flow for early-stage essentials, with lease payments typically accounting for about 17% of total costs. Financial modeling shows that leasing secures superior short-term margins. For a startup generating $120 million in revenue, the leasing model yields a net profit of $12 million and a 10% profit margin, compared to a lower profit for the ownership model. Leasing leads to drastically improved capital efficiency, as shown by higher return on assets and operating margin compared to ownership. This model maintains a significantly lower debt-to-equity ratio, creating a healthier balance sheet for investors. Leasing provides operational agility, and industry consensus supports its benefits. 60% of professionals agree that leasing allows for efficient network expansion, and 56% find it critical for maintaining a modern, fuel-efficient fleet, insulating against technology obsolescence. A critical catch is the utilization trap. Financial success in leasing is strictly conditional on high aircraft utilization, as fixed lease costs must be paid regardless of whether the aircraft flies. Low utilization drastically increases the break-even load factor. Emerging markets face contextual vulnerabilities, including currency mismatch, where airlines pay leases in USD but earn revenue locally. Blocked funds and regulatory friction, with high surcharges and complex payment procedures, also compound leasing costs. A strategic playbook for startup airlines suggests 3 phases. Phase 1 prioritizes operating leases for maximum flexibility. Phase 2 introduces a balanced mix to stabilize costs. Phase 3 involves selective finance leases for long-term control over core assets. For management, prescriptions include avoiding the liquidity illusion and stress testing lease commitments against low utilization scenarios. For regulators, improving foreign exchange convertibility and establishing clear legal frameworks for aircraft repossession are key. Aircraft leasing is a market enabler, not a magic bullet. It is a strategic necessity for market access and preserving liquidity. Sustainable profitability is only achieved by integrating leasing with relentless operational discipline and maximized aircraft utilization.